Hello, Providence Financial friends and family. Anthony Sicaro here, founder and president of Providence Financial and Insurance Services located in Woodland Hills, California. Also host of the Providence Financial Retirement Show, which airs every Saturday on AM 870. KRL lays the answer. And if you don't listen to my show on a regular basis, the good news is you can catch our radio show on our podcast because every Monday it airs at 6 o'clock a.m. It becomes available, and then you can go search it and listen to our radio show on your podcast. And you can find our podcast at providencefinancialpodcast.com or just search for the Providence Financial Retirement Show on your favorite podcast player. And podcast comes out Monday morning at 6 o'clock. That's a replay of Saturday's show. And then again Thursday, and that Thursday podcast is just for our podcast listeners. But if you go right now, it's probably a couple hundred shows there. You can just pick the ones you want. Now, this video is not about the podcast. Sorry that I had to throw a cheap little plug in there to begin with. But often I will put out videos having to do with what's going on in the market. And these videos are primarily designed for my clients. If you're a client of ours, thank you for your business. Thank you for your trust. So I've done a lot of TV interviews recently, even a podcast interview with someone that has hundreds of thousands of listeners. And the question always seems to be the same recently, and that is, what do we do? Matter of fact, one of the podcasts that I just did is, what do we do? So I want to just take a few minutes, hopefully less than 10 minutes, and answer that question. What do we do? When you look at the world around you economically, there's a lot going on. The most recent thing that's going on has to do with COVID and has to do with the fact that the Chinese government has just announced that they're going to shut down manufacturing in certain areas. They're going to shut down ports, and they're basically locking everyone up. And if you pay attention to the news, you know that you've heard that. Well, that's not good for corporations because the Chinese is a big market. And the reality is that that's going to affect corporate revenue, and corporate revenue is going to affect corporate profits, and that means it's going to cause stock prices to go down, and that's part of what we've seen in the last couple of days. Today the market was down over 800 points. Dow Jones down over 1,000 points the other day. Stock market as a whole down generally about 12% from its all-time peaks. So that and the most recent is because of what's going on in China. But we can't forget, we still got a war going on in Russia, and that's not a huge impact on the economy. Another impact on the economy is inflation. The March numbers, year over year, March 2021 to 2022, inflation was 8.5%. And I don't have to tell you things are more expensive. You just know that by going to the store or going to the gas pump. And so that means people are going to spend less because they're not getting as much and they can't afford it. So that's not good for corporate revenues. And then you've got the Federal Reserve basically saying that, next week they're probably going to hike rates by 50 basis points, which is 0.5%. It's a big move. And so all of that put together really means that corporate revenues are probably going to be down. And the fact that corporate revenues are down, that's going to affect the stock price. And that's why I think you're seeing the volatility that you're seeing and why you're seeing the declines in the market that you're seeing today. Earnings reports have come out strong. A lot of companies have reported solid earnings, and you would think then that lifts the market, but that's not the case. The market is forward thinking. The earnings report happened last quarter, and the market's saying, we don't care about what happened last quarter. What are you going to do for us next quarter? So the reality is that the market's forward looking. So that's why earnings season doesn't seem to be affecting the markets. It's just kind of secondary, whereas normally it's primary. All of these other things have taken the focus of the market. Now, the challenge with the stock market is we have no idea where it's going to go. Goldman Sachs last week came out with a prediction that they said that there's a 35% chance that the market has a recession in the next 2 years. A recession is officially 20% down. The market's already down 12%. I think we could have a recession within the next 2 weeks or 2 months. I mean, we don't know for sure. So it's not a prediction, but that's what Goldman Sachs is saying, 35% chance of a recession in the next 2 years. But that also means there's a 65% chance that we don't ever get down by 20%. So we can't say, well, that means there's going to be a recession. The thing is, we don't know. Now, Bank of America also came out and said that the next decade is likely to produce zero returns for the stock market. They said that. Now, if you've listened to my podcast at all, or we've had conversations one-on-one, you know that that's not news to us. Right? We know that there have been many decades in a couple hundred years of stock market history where the stock market has produced zero return. As a matter of fact, there's been longer times than decades. There was one time period in market history where for 25 years, no growth in the market. Ups and downs, crashes and recoveries and crashes and recoveries. But at the end of the day, the crashes and recoveries watch each other out so that there's no growth. There was one time period, 25 years, no growth. But there was also a 20-year time period, no growth. There was also a 16-year time period, no growth. Most recently, 2000 to 2013, no growth. And now Bank of America is predicting that for the next 10 years, maybe no growth. And I'm going to say that it could be for the next 15 years. We've seen this as a pattern in the market. The market will have good decades, followed by bad decades, or flat decades, followed by good decades. The market has just had 13 years of almost 15% per year average returns. It's a pretty good 13-year period of time. And we know that what goes up must do what? Must come down. It's not going to go up forever. But here's the good news. When the market comes down, what goes down must come up. The bottom line, though, is that it may take a long time to do that. When we had COVID, if you go back to February of 2020 when COVID started, you might remember that from February to April, 37 days, the market lost 37%. That's a pretty big crash very quickly. Didn't give us any time to respond. Didn't give you guys any time to respond. But 6 months later, what happened? It was back at record highs. That's an anomaly. That's never happened before. You heard the news reports. Fastest drop in history, fastest recovery in history. That's not the way the market normally works. And I don't want it to give you a false sense of security that, oh yeah, if the market crashes again by 20 or 30 or 40%, or we go into a recession, that I'll just wait for 6 months and it'll be back to normal. No, it's not how it normally works. Okay? And if you're banking your retirement on the fact that that's the way it's going to work, I just don't want you to be in trouble down the road. So let's go back. Let's look at the year 2000, right? If you were sitting in the year 2000 planning on retiring in 2002, well, your portfolio between 2000 and 2002 got cut in half if you were invested in stocks. Okay. And then it took you until 2006 to get back to even. So from 2000 to 2006, crash and recovery, no growth, 6 years. If you go back to 2007 and you were planning on retiring in 2009, well, between 2007 and 2009, there was a 60% crash in the market. What if you were planning in 2007 to retire in 2009? You had $1 million in 2007, and now in 2009, you only had $400,000. How would that affect your retirement? The reality is we had people that couldn't retire. We had people that were, most of my meetings in 2009 were people coming in crying, and I'm not kidding. So crash from 2007 to 2009, almost 60%. And then it took until 2014 to recover. 2007 to 2014, crash and recovery, no growth. And that means essentially that from 2000 to 2013, no growth in the market at all. And if you were in stocks in 2000 and you were planning on retiring anytime in that period, there's a good chance that you might not have been able to retire because the market didn't go in your favor. And 2009 was the bottom of the market, the bottom of the financial crisis. And from 2009 to 2022, the market's gone straight up, almost 15% per year returns. And Bank of America has predicted that we have another period like this 2000 to 2013 period. And I think that that's got a possibility to it. And I want you to be prepared. I do not want you to be in a position so that your retirement or your plans and your dreams and your goals depend on what the stock market does. And I don't want you to be thinking that, the market did well in the last 5 years, so the market's going to do well in the next 5 years. Wrong, wrong, wrong. And you've heard me say lots of times that if your plans and dreams depend on what the market does, you are invested wrong. You can't count on the market. Right now, we have no idea what your portfolio or what stocks are going to be worth in 1 or 2 or 5 years from now. If you have $1 million in stocks right now, in 5 years, it could be worth double, although not likely, but could be. Can't say it can't be, but could be. But it could be worth half. It could be worth less than half. And there's a wide range there. That means your $1 million could be worth $2 million, or it could be worth $500,000 in 5 years. And if you can't retire to $500,000, then you're invested wrong. So you can't count on the market. So what's my advice? Invest in what you can count on. You can count on interest and dividends if you're invested for income the way that we teach you. And by the way, if you're living off your interest and dividends, then it doesn't matter what happens with the market. And I just want to remind you of that. If you have $1 million and you're getting $40,000 to $45,000 a year of interest and dividends, and that's our target, 4 to 4.5% after fees, you're getting $40,000 to $45,000 a year. If you're living off that $40,000 to $45,000 a year, and your $1 million portfolio drops to $800,000 or $900,000, you still get your income. As long as you're not selling shares, that drop didn't affect you. Same thing if your portfolio grows the other direction. You get your income, you're living off your income. So the short-term fluctuation doesn't affect you at all. Well, what if you're in a position where you're not selling shares? What if you're reinvesting? Well, guess what? If your portfolio goes down in value, well, now when we reinvest that $40,000 to $45,000 a year, you get to buy more shares because the price of the shares is less. So when the value comes back, or when the share price comes back, you actually come out smelling like a rose because you have more shares than if it had never dropped in the first place. So if you're taking income off your portfolio, then a drop doesn't hurt you. A drop in the value doesn't hurt you. If you're reinvesting your portfolio, then a drop in value helps you. But you have to remember something. This is something that happens over years. This is, we're investing for the long run here. We're not talking about a drop in portfolios over 6 months and then the next 6 months is gone. We could be, matter of fact, our clients' portfolios have kind of been dropping for a little while now, for probably a year and a half or two. Why? Because interest rates have gone up, and fixed income portfolios tend to go down when interest rates rise, and interest rates have been on the rise. So, and there's been some of that shock just in the last couple of months. So a lot of you have seen your portfolios go down, but I want to remind you, it doesn't matter. The portfolio bounce doesn't matter because it doesn't affect your income. And if you're reinvesting, it actually helps you. And in the world of investments, what go down must come up. Nothing goes down forever. Nothing comes up forever. But this is not something that, it's going to go down next week and then go up the following week. No, this is something that is happening over a period of years. Could be a couple of years. Now, the reality is I would expect that if the stock market starts to have some major problems, as I almost feel like we're on the brink of, I'm not going to cry wolf. We don't know. But if it starts to have some major problems, I think the Federal Reserve is probably going to be forced to lower rates again, or to talk about not raising rates any further. And if they do that, then a lot of the fixed income portfolios may bounce back. So, we'll see, but it's going to fluctuate. It just doesn't hurt you. But a lot of you have seen your portfolios go down, and you just have to remember that we're invested for income, and it doesn't matter. So back to the question, what do we do? Invest in things you can count on. And right now, about the only thing I think you could count on is income. Now, before we wrap up, some of you might be asking the question, well, should I get out of stocks now? Let me call Anthony and tell him to sell all my stocks and we'll wait for a better time to get in later. Should I do that? The answer is probably not. I've had many conversations with most of you, if not all of you, over the course of the last year, because we've had a rough year. The market's been bouncing around like a yo-yo, and really I think even the last 6 months especially, market's been bouncing around, and there have been several times we've hit a correction twice. And I've put out other videos, and a lot of you have called me. Here's the position that a lot of you are in. A lot of you have a small amount of your portfolio in stocks, and we have set you up so that you're not overweight stocks. You don't have too much in stocks. A lot of you have some, 10 or 20 or maybe 30% in stocks, with the idea and intent that if we have another recession or if the market does go down, you have enough ammunition to buy more stocks later. And if we've had that conversation and that's the strategy we set up for you, then I would stay the course, because we don't know whether we're going to have a recession or not. Remember, a 35% chance of a recession, as Goldman Sachs said, means there's a 65% chance that we don't have a recession. So I don't think it's appropriate to go abandon all of your stocks. And remember, every single one of you that has stocks with us, you're getting dividends, probably 3 to 4% of dividends on your stock portfolio. So you still get the income no matter what happens. So the reality is, if you have stock now, unless you just have a huge amount, that much more than you're comfortable with, just leave it as is. But if you have much more than you're comfortable with, call me. Let me know. We'll have a conversation about it. But I also want every one of you to be in a position to where if the market does drop 20 or 30%, that you would feel comfortable adding more to the stock market. So if you're in a position where you're saying, I don't think I want to, add more to the stock market at some point down the road because maybe you have too much stocks now, then call me. Let's talk about it. Okay. But I think with inflation the way it is, we're going to have to shift some of our focus into stocks. We've already done that with a lot of you, again, on a small percentage. But I think, and I want you to make sure that you've got room to add more stocks later if we do have a major crash in the market. Otherwise, you're not taking advantage of that. With an 8.5% inflation rate, inflation that's come up, bottom line is we have to pivot. We have to do what we can to help you keep pace with inflation. And that's the best way that I know how. Get your dividends along the way. Keep investing for dividends and income like we've talked about, because you can count on the dividends and income. And right now, it's about the only thing you can count on. So hopefully this helps. If you have any questions, again, feel free to contact me. You can look us up at providencefinancialinc.com, and more than happy to have a conversation with you. Hope this helps. God bless.